Let's welcome the brains trust of Nomura India. They have joined us in the studio this morning. Prabhat, Awasthi, Head of Equities and Managing Director, India. Sonal, Varma, the India Economist, and Neeraj, Gambhir, Managing Director and Co-Head, Fixed Income, India. Well, gentlemen and lady, thank you very much for joining us. Let me start with the lady because it's macro data that we have that we are getting, and that's what the market is watching. What will the governor do? What's your sense, Sonal, with the inflation data coming in and increasing pressure, as you can see, even from not just India Inc., but even from the government? You think the governor might just relent since he has a penchant for surprising the market as well?
Well, not at the December 2nd policy meeting. I think the RBI's credibility itself is at stake. And 6% really was the intermediary target. The ultimate target is probably around 4%. It could be, a bit higher, we don't know. So the entire framework of monetary policy is going to undergo a change as we get into 2015. You're getting into more a rule-based monetary policy framework with a medium-term target of inflation staying in a band. And we need to remember that, part of the moderation in inflation we are seeing is because of government measures, but part of it is also because growth has slowed down. And now we are at a stage where growth is starting to bottom out. And our view is you will start to see growth picking up into next year. So what impact that has on the inflation outlook in 2016, 2017, because we are moving towards a medium-term framework, will be important. So that is a consideration RBI has to take into account while taking the interest rate decision. I think clearly with inflation coming down, there is probably some room opening up, but the question really is, how much room is there?
Okay. And when also.
Yeah. Growth has slowed down, but growth is picking up. Those were the two axioms you gave us. Prabhat, on that, what did you make of the second quarter earnings? Were there more misses than hits for you? And when exactly do the earnings start clearly tilting in favor of hits?
So I think this quarter, when we were looking at the data, it's almost equal. There's actually slightly more misses, but it's even Stevens actually not very far from each other. So it's 50-50. But the overall numbers themselves don't tell you a story of pickup at this point in time. Growth, for example, for our universe in sales close to 5%, which is the lowest in last 4 quarters. To be expected, I think, primarily because the rupee impacts have sort of worn off. In fact, rupee impacts are negative, commodity prices are weaker, and there's a large impact of commodity prices on top lines. So I think on a sequential basis, we are still, at least if you look at the earnings, they are not telling you yet of a story of pickup. But as I said, these are historical numbers. You could actually start seeing something, some acceleration in earnings, I would think, in the 6 months or so. Before that, there are patches where pickup has happened. For example, autos, we have seen better data, but the core sectors still are generally weak. And I think once the government's actual sort of efforts start paying off, which might take another 5-6 months, you probably will see a better picture.
Okay. Prabhat, Sonal, Neeraj, morning to all of you. Prabhat, you've come out with an August 2015 Sensex target of 30,300. What do you think are the leaders of the next leg of this rally?
Also, actually, what has not done well has to be that, I guess, because we have seen a fantastic performance by the defensives in India. Consumer and pharmaceuticals have been the standout performers over a period of 3-4 years. Obviously, 1 year, I think, consumers lagged a bit. I think the most important and the biggest sector in India is financials. And as macro improves, as Sonal was saying, as growth improves, that sector has to be the leader. Valuations there are still comfortable, so they are still trading at discounts to their average. If you look at 5-year average, 3-year average, they're still trading at discounts. To some extent, because there were concerns on the sector, led by, for example, bad asset concerns or NPA concerns. These are getting resolved, and if policy improves, you'll see more movement towards that. So if you get both growth policy and sort of inflation cycle right for them, then they have a lot of room to move up. So I think financials probably is the best spot over the next 2-3 years.
When you say financials, are you more tilted towards PSU banks? I mean, I'll come to Neeraj in a bit on where he sees bond yields. But are you, at the moment the market is tilted in favor of PSU banks. Is there a near-term advantage? Will the earnings delta be better there?
It's possible because the asset quality concerns have been larger on PSU banks, and that's why they actually were underperforming the private banks for a very, very long time. And in this cycle, I think growth per se, I think, is a problem for almost the whole sector. Obviously, retail banks will probably do a bit better, but the valuations differentials are higher for PSU banks. So as these concerns lift, there's a possibility that, so you have a near-term outlook and a longer-term outlook. Longer term, if you sort of think about compounding of earnings and loan growth, then private banks will continue to do much better. But at this point in time, if you look at 6 to 8 months period, then it's possible that PSU banks might outperform. But I said, you have to be very cognizant of the fact that within PSU banks, the asset quality concerns are very, very varied. So you have to be very stock specific when you start looking at these things.
Can you?
So SBI is what we like. Yeah, we like SBI. It's very easy for us. So that bank has done well. They're already shown it in the results also. So we like SBI quite a lot in PSU bank.
Okay, I'll come back to the financials again, but Neeraj, to get you into this conversation, if we remember the previous cycle, and at least you and I would remember that, and I guess Prabhat as well, the big thing that helped PSU banks out of the NPL cycle in the 2003 period was the gains they made on their bond portfolio. What kind of gains are you expecting in the next 1 year?
Well, I think we could have a fairly decent and secular bond market rally over the next 12 to 18 months. Especially if if the inflation continues on the trajectory that we are looking at, and there is more space that opens up for the monetary policy to ease up, given the fact that we are actually pretty weak in terms of growth. Reserve Bank, I think, will at some point in time think of reducing the interest rates, and that augurs pretty well for the bond market, and that's what you're seeing. I mean, if you look at different parts of the bond market, they're telling you different things, but the most aggressive projection at the moment is in the swap market, which is forecasting a 100 basis point cut in interest rates over the next 12 months. The bond market is not yet there. I think eventually both the markets have to speak the same language. So I'm pretty hopeful that over the next 12 to 18 months, we'll see a persistent sort of and steady rally in the bond market. And that will obviously help the banks, because they're sitting on a large portfolio of these bonds, and they can churn some of this, and that actually in a way it kind of helps in terms of backdoor capitalization of the banking system. It's the cycle, right? That's the same cycle we saw last time. Growth slows down, impacts the non-performing assets. Reserve Bank has to cut the rates to make sure that the growth comes back in, and that helps the bond prices, and that helps the public sector banking system in a way. So I think that's exactly the same cycle they'll probably see, but not at the same level that we saw last time around. It was almost a 600 basis point reduction in the bond yields last time around. This time around, I think probably 200 to 300 basis points, provided inflation sort of continues to be on the path that we see.
A little more granularity. I mean, Sonal will be speaking about her timetable of the Reserve Bank rate cuts, but can gains in the bond markets come much ahead of the rate cuts? For instance, what's the view, say, in February when there will be no auctions? Do you think that you could get a sub 8% 10-year yield even before the Reserve Bank cuts?
See, as and when the market gets more comfortable and convinced about future rate cuts, the curve has to invert. The curve will probably invert. We are seeing that inversion, as I said, in the swap curve. And swap curve inversion is speaking about a 100 basis point rate cut over the next 12 months. Bond market is not yet there, but it will probably get there as and when the data starts supporting that view. So yes, we can potentially see a sub 8% level, but I think we need to get past the December 2nd policy. We need to hear the governor's mind on that, and then I think the market will take on from there.
Prabhat, you were talking about the banks, but the other best proxy to play the macro recovery is the infrastructure, capital goods space. Where does L&T feature in this list? And do you stick with a large cap like L&T, or do you sort of broaden your view into some of the mid cap names, the good performing names like Voltas, etc.?
So, over a longer period we like, so it's a sector we are overweight on. The only issue is that these are lag cyclicals. So they always lag a recovery, or they, lag even a slowdown. Because the fact is that a slowdown essentially needs, leads people to reassess their capital requirements, how much they want to put in terms of capacity. And therefore, if an auto guy is putting a plant, he'll only figure out after a period of time the demand has slowed down and got more capacity. And that's why the lag is about a couple of years. So I think the challenge with the capital goods stock is that the valuations have gone up, but the numbers are yet not stacking up because the new order inflows are weak or weakish, let's say. So I think if you take a 2-3 year view, obviously these stocks can outperform quite a lot because their margins are depressed. Therefore, there can be margin recovery and a sales recovery both, and the valuations they're trading today could be justified. But over a 1 or 2 year, or let's say 6 months or 1 year period, I'm not so sure that they will outperform, let's say, banking stocks. Now, L&T obviously is the bellwether of the sector. They have weathered the cycles through and through. So they are like your private bank space in a banking sort of. So they are the guys who are able to sort of hold the fort when everybody else is suffering. The smaller stocks, again, there has been a massive differentiation which has opened up, as you can see in the performance of various companies. The pure construction companies have seen much more pain, and the companies like which are well managed, like Voltas, have sort of come out of it at this point in time. So we like Voltas, for example. So I think story becomes very, very stock specific when you go down, because within capital goods space there are many hues. There are power stocks, there are industrial stocks, there are stocks which are basically play on manufacturing capex recovery. So you really can't paint everything with one brush here. I would think that infrastructure recovery will take slightly more time, even though I think signs of that will start emerging as governments start taking more action. The manufacturing capex recovery probably is going to be faster because that is based on what manufacturing sector feels about the future performance. In infrastructure, you need to take care of the balance sheets of the players which are very, very distressed. You take care of a lot of rules, land acquisition bill, etc. All those things might take slightly more time.
Where is the rupee headed, Neeraj? Yesterday's exports were the lowest since April. Not by a whole lot, but still they were the lowest since April. They were a good 10% lower than the September numbers. Is rupee appreciation beginning to hit? And what do you think the Reserve Bank may do?
See, I think if you look at the overall BOP data, not just the trade data, clearly we're getting a tremendous amount of flows into the country, right? So overall BOP seems to be pretty positive. And it's Reserve Bank which is buying all the dollars from the market, right? So if you see the size of intervention that they've done over the last, let's say, 6 odd months, it's pretty large. So to me, I think it's not the market which is deciding where the rupee is, it's really the Reserve Bank's intervention style and their timing which is deciding where the rupee is. And clearly they don't seem to be wanting to see a meaningful appreciation in rupee. Whether it is driven by the trade competitiveness, it is a time of competitive devaluation, I would think. Or whether it is driven by the concerns around hedging by the corporates. I think the bottom line here is that we are seeing a weaker rupee because Reserve Bank is intervening pretty actively and pretty aggressively, and that is determining where the currency is ultimately.
Actually, it is not a weaker rupee. The latest REER number indicates that the rupee is overvalued by 10%, and those are uncomfortable levels. February 2012, just on the eve when we started depreciating, we were at 10%, and that led to a lot of problems.
Yep. So I think so that's the other aspect, which is basically that you're just looking at the dollar rupee. What about rupee versus various other currencies? What about rupee versus, for example, yen? I mean, that's kind of pretty strong. So if you look at it a wider basket, so rupee has indeed appreciated reasonably well and has done much better than many other emerging market currencies during this phase of dollar strength. So clearly I think there is a element of maintaining competitiveness into this intervention of Reserve Bank and making sure that we don't overvalue too much during this phase when we're getting too much flows into the country.
Prabhat, would you worry about this as much to believe that some of the merchandise exporters will not do as well as they did? I mean, look at the Bharat Forge numbers. Largely a contribution from exports. Will something get chipped off in the coming quarters?
Well, I think, first of all, the exporters, for example, if you look at, generally they are dollar-denominated guys. I mean, commodity exporters obviously are dollar-denominated. it, so it doesn't really matter. So you know where you're exporting, you're given a price. Just steel export, it doesn't matter. Yeah, you could have made more money if you're situated in Japan, but you know the dollar numbers are out there. They'll basically they might actually sort of get hurt because commodity prices are going down, given the fact that Indian rupee is much stronger compared to other currencies. People like Bharat Forge, I think again the question is how much are they competing in terms of with other countries, and I don't think some of our engineering exporters really compete that much on currency. I mean, take Bajaj Auto for example. I mean, they have carved out a niche for their products rather than sort of selling into a commodity market. So I don't think there is a big problem, frankly, from their perspective, because most of these guys are selling in dollars. They could have made more maybe if rupee was depreciating, but I think they're still okay.
By the way, the market has moved higher in the last 5 to 10 odd minutes. So there's a sudden spike that we're seeing in the index. The Nifty has now conquered 8450, and the mid caps are up 1%. So fresh highs seen on names like Bank of Baroda, Tata Motors, SBI, all of these stocks sitting at fresh 52-week highs. Prabhat, I was looking at some of the sectors you're overweight on, and interestingly, you have entertainment in that space. So media stocks like Z Entertainment, Dish TV, etc. In fact, as we speak, Z Entertainment is sitting at a new high. What is the prospect for this sector? And is most of the run done, or do you think that there's lots more to go?
Well, I think I think earnings compounding sector is very strong and will continue to be strong while there has been some delay in the digitization process, but the fact is that it's an inevitability. And I think they also benefit from a recovery in economy, because ad spends also are sort of discretionary in nature. So if you actually see a recovery, they can actually, stocks like Z can do well. And they're great business models, because, especially for Z, for example, you've seen the company has sort of balance sheet has become completely fine over a period of time. So we think that earnings growth trajectory of media companies in India is underpinned not only by a recovery but also by a regulatory change, which is not yet fully manifested in the earnings. And for a sector which is very large globally, India media sector is very small in terms of market cap still. That story doesn't always play out, but I think the stage we are in and the kind of changes we have seen in the regulatory environment, I think we should be all right. But as a small sector, as I said, cannot influence the market, but it can do well standalone over a period of time, yes.
Would you watch out for the divestment program? I mean, before I come to the fiscal deficit question to Sonal, you think there will be a rush of divestment candidates in the market? Would you have any preferences? Would you like the oil guys, for instance, or Coal India?
Well, I think this has to happen anyways, because we are delayed, so there has to be a rush. I think a lot depends on what the government does over a period of time in terms of the reform process, which makes it more positive for foreign investors or investors who get into these sectors. So for example, what we've heard in papers on LPG, if that was to come through clearly, then ONGC does become more attractive, because the long-term visibility on subsidy improves. Similarly, in Coal India, for example, if the coal reforms, for example, if production numbers that Mr. Goyal has been talking about, doubling production, if you get more granularity in that process, and I know that a lot of work is going on in Coal Ministry. If that happens, then, so I think the issue about PSU, especially the large PSUs that we are talking about, are that they're not expensive. They have been cheap for a reason, and these reasons get better because you're getting more positive in governance, then you start getting more positive. It'll be probably better for the government to get some clarity out in the market, for example, on subsidies on oil. This LPG thing, if it sort of becomes more clear, then I think there'll be many takers for these stocks.
But already you would buy ONGC, or you would recommend buy on ONGC?
We have been positive on oil sector as such, including all oil PSUs. So that has been the main reason that the government is moving in the right direction.
Okay. Sonal, on fiscal deficit, do you think they'll better the target? You think there'll be a further crunch of planned spending because inflows are questionable at this point in time?
So FY15 actually is sort of a transition year for the fiscal finances. Unlike the last 2 years, so we again have a similar problem as the last couple of years, that we are running behind the target. But the difference from last few years is that this time revenues have lagged behind. Spending actually has moved broadly in line with the budgeted target. So the problem really is on the revenue side. Now, part of this is because the tax refunds lined up this year, close to 1,20,000 crore. crore from, again, not paid from last year, have spilled over into this year. The non-payment of subsidies from last year has spilled over into this year, and growth is still sort of in the very, very early stages of the recovery. So the austerity that the government announced a month back will actually largely make up for the loss in tax revenues.
Okay.
And therefore, if the disinvestment target is not met, then additional round of expenditure cuts will have to be announced to get to the 4.1% target. I think the fiscal situation should look much better next year because the subsidy burden's coming down and tax revenue should pick up next year. But this year it will all boil down to what they actually, if they are able to manage the disinvestment target or not.
Okay. On that note, actually, the next big trigger from the market's point of view will be the winter session of the Parliament. Prabhat, what are you expecting in terms of the fine print of GST that could be announced, and what will make the markets happy?
Well, I think, first of all, the actual numbers on GST will probably be still some time coming, because we have heard all sorts of numbers there, 27, 23, etc., etc. But I think from what I understand, we are closer in terms of resolution of most of the pending issues, fundamental issues between states and center. So so GST is one, for example. I think getting coal ordinance through is another one, because they have sort of done it through an ordinance route. They have to, maybe not in this session, they still have some more time. Land acquisition bill is another one, which is a very large one. I think even more important. So I think the visibility on some of the key reforms which have been impeding on the growth of investments will probably be key. I think I rate personally land acquisition as a more pressing issue. GST, they have said they will do it by 2016, so they still have time. And from what I understand, as I said, states are getting on board. So getting it passed is probably a matter of time. But yeah, I think the last session of the insurance bill, for example. So the last session of Parliament was a bit of an anticlimax, because what we heard was that, at least in terms of getting two things passed, insurance bill was one of them, right? So insurance bill didn't get done. If you can get some of this stuff done, it will be very positive from market perspective. They still don't have the numbers, so we'll have to see as to how they manage Rajya Sabha, etc., etc. So.
Actually, considering the brain trust of Nomura India, we should be asking you more Japan questions as well. Actually, on that, Neeraj, I mean, all of you would be having your finger on the pulse of not just Japanese investors, but foreign investors in general. Japan is quite clearly on the verge of greater monetary stimulus, and going by what the ECB is saying, there is going to be more government bond buying as well, perhaps in that continent as well. How is the mood looking? We've seen a robust flow of FII money. Is the tap just going to stay that way or even get better?
So,
especially from Japan.
Yeah, I think as far as Japan is concerned, we've been at it for a while now in terms of trying to see how we can get more flows into this country. But traditionally, the Japanese institutional investors have not really invested too much out of Japan in terms of, especially in the emerging market countries and countries where the ratings are just at the, at the investment grade level. So we are seeing a small trickle in from Japanese investors. Clearly, they are becoming more and more interested in the India story. And I would say that the trips by the Prime Minister to Japan immediately after taking over has been a big, big help in terms of selling the India story in Japan. But I think it's still a beginning. And typically, the Japanese investors take a fairly long period of time to get comfortable with the idea, get used to it. And then once they start investing, it sustains for a longer period of time. So I think that we are at the beginning of that process as far as the bond market is concerned. And as far as the other jurisdictions are concerned, we do see continuous flow, particularly from US investors and European investors. We do see the interest is actually increasing. I mean, especially in the bond market side, I think if you see, traditionally India has been very underrepresented by these in these investors' portfolios. I mean, we are not part of any index. There is not much. Markets were closed. It wasn't easy for them to come in and invest. Now we get the kind of queries as to, okay, I'm interested. How do I invest, right? So obviously, and I believe it's a start of a cycle again, and I think this should sustain for some time.
But Prabhat, on equities, the doors were always open.
Well, I think equities, the problem was the currency. So actually, Japanese investors suffered a lot because they started coming around 2006, 2007, and so Well, I have a data point from one of the large distributors of funds in Japan that at peak the Japanese investors put $12 billion in India, which went down to $4 billion early part of this year. And so there's a big upside from Japan. And as Neeraj said, after Prime Minister's visit, there was a fair amount of inflow which started coming into funds from Japan. So remember one thing, that there are a lot of funds which put money in India, which get inflow from Japanese retail, but they are not necessarily situated out of Japan. They are situated in Singapore, and they could be European money managers who are getting Japanese money to invest in India. So that has started to happen. And I and Sonal were there in Japan about 3-4 months ago, I think, and we had a full house. I can tell you that the interest levels in Japan have risen tremendously, and they are looking at India more closely. And third thing, I think, is even in Japan there is a push to diversify the investment outwards. So like GPIF, the government is telling them to sort of diversify out. So that money, a couple of $1 billion expected to come into India from that loan in the next 18 months. So there is going to be much more, I think, into India going forward.
Actually, apart from the interest on the institutional investors side, I think one thing India is likely to benefit most is the FDI flows. One of the biggest concerns for most investors, especially the Japanese investors, has been ease of doing business. The processes are too lengthy. And now you're starting to see the government actually focus on ease of doing business. And Japan actually, if you look at Asia, has been an important player in terms of the entire supply assembly chain in Asia. And they're looking to diversify away from countries like China. A lot of the money has gone into the ASEAN economies, it's gone into Vietnam, and they're looking for new countries which offer growth, which offer the economies of scale, and where the ease of doing business is easier. So I think apart from the money on the institutional side, FDI, the stable money which regulators will be more comfortable with, that's where India is likely to see a big increase. And if you club that with an environment where commodity prices are coming down, so your current account deficit is within 2% of GDP, then bulk of your current account deficit actually will be financed just through the stable FDI inflows, and that actually makes your macros quite stable.
All right, so one last question. Since we started with the lady, let's end with her. Do you expect to see at any point in time in the next 6 to 8 months a ratings upgrade? Is there anything in the macros that indicates that India is headed towards an upgrade?
Upgrades usually take time. I mean, if you've seen, Standard & Poor's has just put India on a neutral stance, stable outlook. So you would first need to see the outlook getting upgraded to positive before there's an actual upgrade. We are probably moving in that direction, but 6 to 8 months is too short a period of time. Rating agencies need to see growth picking up, per capita incomes actually starting to pick up, investment cycle turning around, potential growth turning around, continued reforms from the government. So India will stand out, but I think a bit too early for a rating upgrade in the next 6-8 months.
8450 on the Nifty and Sensex at 28,300. Prabhat, you want to use this forum to change your Sensex target. It is August end 2015. Sensex target is 30,300.
No, absolutely not.
Are the markets beckoning to up it?
We know Prabhat well enough now that he takes a while before he changes his target, and you've recently just done that, right?
Yeah, I think it's a 1 year. It's not a 1 year target anymore, right? Yeah. So we are already in November.
It's 8 months,
so if we roll it forward by about 3-4-5%, you'll so a 1 year target will be anyways have to be rolled forward for earnings. And if we really think start improving on the policy front more than we expect, then we'll have to take that into cognizance. But we are working with a higher multiple compared to history. So anyways, we have taken some of that into account. And also remember that large part of index is defensives in terms of rate. So if you banks do really well, but the consumer sector lags, then the weighted impact might not be as large as we sort of expect, right? So I think we have to be cautious about that part of the, just looking at the headline index saying, well, this will go up a lot. So you could see sectors which go up 30%, but the index rises much less because the other parts which will lag in the cycle.
Well, you people have been speaking about some groundbreaking changes in terms of investor interest in India. So perhaps higher valuations are going to be tolerated if the political economy supports that. Prabhat, Sonal, Neeraj, thank you very much for joining us and for this very enriching, enlightening discussion on CNBC TV 18.